Hello, my name is Eddie Tofpik. I'm Head of Technical Analysis and Senior Markets Analyst at ADM Investor Services International Limited. And here is your weekly technical analysis of the Chicago soybean complex.
Chicago soybeans. 23 weeks ago, and at every opportunity since, I said here, and I quote, "The only other thing to bear in mind is not here on this daily chart, but in Chicago soybean meal." And that is the well-highlighted annual key reversal down we saw there for 2023. Not directly related here, but not worth ignoring either, end of quote. Now, I know I sound utterly boring about this, but this point is important. I feel I must keep repeating it, such that in all things this year and going forward, all things should be seen in the shadow of this pattern. Okay, so from the May double top, we have seen prices head lower at the start of June and thereafter. 13 weeks ago, I did a small bright red highlighted bearish Andrews pitchfork, the action during May and until mid-July, and I had really nothing more to add to this pattern. It was not perfect, but it worked well enough until the changeover gap, and even then I'd kept it on my daily chart to show the bearish angle of attack. We are right now between the broken and seemingly repaired bright red middle time below, currently at 9.53, and the upper time above, currently at 10.27. Going back to the changeover break period, the move down had been quite swift, notably 3 weeks ago when prices reached down to the combination of the September 2020 low at 9.42 and a dark blue optimized extension to the February to October 2021 head and shoulders top, currently at 9.35. However, the market did not like it down here, especially testing those two, the September 2020 low and a dark blue extension, and prices turned higher, only to not meet the now broken bright red Andrews pitchfork from below this, the now broken bright red Andrews pitchfork from below this time, but also the first of four bands of static supports that are now resistances. The first was at 9.90, and the second was and is at the October 2020 low at 10.17, which has been tested this week. The third is congestion between 10.31 to 10.33. And finally, the fourth is the November 2020 low at 10.45. That is currently being reinforced by the declining short-medium moving average, currently at 10.46. I asked this question last week, and I quote, "The question now is whether what we have seen throughout August turns out to be a base building for a further move higher or just a temporary halt on the road lower," end of quote. Well, last week it looked like it might be a temporary halt, though it did extend that into possibly being the third way of going sideways, within a relatively wide range. However, I did add the following back then, that is still valid now, and I quote, "Until the bright red bearish shift pitchfork is finally broken and not repaired and broken properly, which is what it seems to have happened right now, then this bearish pitchfork will be the dominant feature of this market and the one to watch," end of quote. I still stand by that and would only add that breaking up over the November 2020 low at 10.45 will also now, I suspect, be a qualification. Chicago soybean meal. Back in late February this year, down at 326.90, the market consolidated after a significant fall that developed from the middle of November last year. This congestion was different compared to earlier ones, as it had backing up the purple highlighted extension to the lower trend line, currently at 323.60, of the July to September 2021 descending triangle. I said 25 weeks ago, and I quote, "This may be nothing, but I'm minded after such a fall as we've seen since last November last year, this may see some hesitation around the 327 to 325 zone. I'm not certain on that, but it's worth considering," end of quote. Well, prices utilised this extension to the descending triangle as a base back then and rallied back up, eventually ending up being capped with a double top formed over the month of May of the additional help of the declining long moving average at the time, which is currently at 352.30, and a 50% Fibonacci line of the August 2020 to March 22 move at 390 even. The construction of this double top inevitably led to a move lower, down through the primary and secondary targets, but the key break lower happened at the third attempt, pushing down below the flatlining medium moving average, currently at 341.40 in early to middle July. 4 weeks ago, prices finally rose enough to fill in the significant changeover gap between 335.90 to 319.5. However, this pullback higher was not sustained, especially over the previously mentioned purple trendline extension. And 3 weeks ago, the market moved not only below this, but also down to levels last seen in August and September 2020. 3 weeks ago, I also put forward a couple of features. The first was the Andrews pitchfork for the action between early July to early August. It's a bearish one, obviously. It showed for a while the very recent bearish angle of attack, but the attack did not last. And last week the pitchfork was breached and broken, and I have retired it and replaced it, as I promised last week, by the less acute bearish shift pitchfork for the same move. We are at the moment between the bright red upper time overhead, currently at 328.60, and the middle time below, currently at 307.30. The second is even more recent and even relates to this week's actions. It is the weekly key reversal down made 4 weeks ago, of which we have seen a limited but significant follow-on lower to even weaker prices late 3 weeks ago. Where it relates to last week's actions is that last week prices made a weekly key reversal up, something that should not be ignored. Okay, so 2 weeks ago the moves lower left me wondering what next. The drop itself was halted and turned up, unsurprisingly, by the band of congestion detailed on my daily chart between 282 even to 300 even, dating from April to August 2020. However, does this mean the end of the decline, or just the end of a phase, if you like? I was only also prompted 3 weeks ago to draw a mid-November 2023 to early May 2024 bearish shift pitchfork, highlighted in dark blue on my daily chart, and we can see that the lows of the last few weeks were also testing the middle time, currently at 292.30, much as they did back in mid-July. Finally, 3 weeks ago, I also took a look at the bigger picture here and put forward the possibility that the whole mid-November to date action could be seen as a possible large bearish halfway hesitation. This would give a potential below down in the 253 zone. In other words, down to levels last seen in 2016. And I only need remind you of my words of 62 weeks ago and ever since, so well over a year ago, when I pointed out that Chicago soybean meal was about to have that rarest of patterns, an annual key reversal down. This duly came about at the end of 2023, and we have been living in a shadow of this pattern ever since. The rally this week has started to meet some significant resistances, beginning at the purple trendline extension and February 2024 low. Then at the congestion at 326.90, which is coincident with the declining green short medium moving average, currently at 326.30. The bright red upper time, the 61% absolute Fibonacci line, that's at 336.30, which has the dark blue upper time running through it, and congestion also at 338.10 and 342. That one having the medium moving average running through it, currently at 341.50, followed by congestion at 349.20, then the long moving average, currently 352.30. And then we meet the large, stratified congestion band between 357.90 to 368.80 that I will detail should we get up there. As you can see, there's a lot on top, and we still have the shadow of the annual key reversal down to contend with. It's tough to see right now. Any extensive rally in this market. Chicago soybean oil. The market's drift of sideways to lower this year has been down through various congestion bands. These were and are 44.68 to 45.04, made up of the 2014 high at 45.04 and the May 23 low at 44.68, with the nearby neckline extension of the October 2019 to February 2020 head and shoulders top, currently at 44.76. Then the tight 43.80 to 43.94 zone, made up of the 50% absolute Fibonacci line at 43.80 and the April 2014 high at 43.94. and with the green slowly declining short medium average below it, currently at 43.37, and the mauve slowly declining medium moving average, currently at 43.95, right on it. Next we have the interesting congestion down at about 42.65, plus more recently congestion at 41.15, and support today at the January low at 40.53. Prices 3 weeks ago even looked down at the November 2020 high at 39.04 before a fairly free zone, all the way down to the December 2020 low at 36.56. I mention all these because some 60 weeks ago and numerous times since I've spoken about a big descending wedge pattern that was on my daily chart back then and is now high up off the top of my chart. To cut a long story short, this was and is a big pattern idea, with the expectations I voiced of eventually witnessing a fall down to the area of the May and June lows between 48 even to 46 even zone, which is where we have been until August. I've kept a very, very close eye on this idea, as any significant break below the 48 to 46 zone could signal the start of the rest of this move lower. 6 weeks ago, prices finally punched down through the neckline extension and at the same time started a definitive move lower, below the previously mentioned key 48 to 46 zone. It seemed at the time that the market had come to a cusp and chosen the way lower. And as a consequence, I drew a new early July to late August bear channel. All these actions seem to have secured some significant potentials on the downside. Thus, for the original, big, earlier, much earlier mentioned 60-week-old big descending wedge pattern, we have the following opportunities on the downside. A primary target X would be down in the 33.70 zone, with a secondary, much harder to reach target X1 down in the 16.25 zone. Even a cursory examination of these two targets and one can deduce some notable points. The primary target down at 33.70 is just above the 50% absolute Fibonacci line at 33.45 and is, I suppose, doable, especially if you take into account the monthly key reversal down we saw in July. The secondary target at 16.45 is so far down that calling it harder is a massive understatement. We'd have to be down to levels not seen since May 2002, and I think achieving that is a monumental task and one right now that in all truth I could not endorse. In mid-August we saw the start of what looked like a stronger, higher move up over the upper bear channel line, as well as the January 2021 low, and testing the interesting congestion up at about 42.65. It was enough of a break higher to outline some newer topside opportunities of a primary target X2 in the 48.23 area and a secondary target X3 up in the 49.50 to 49.60 area. However, as I said last week, and I quote, these two targets topside are not too far away from each other, and the move up would have to be quite dramatic to even have a look at them. So I am cautious about them right now. However, it would not be too much to ask for a move up in between the green short medium moving average and the mauve medium moving average, relieving some of the bullish pressures built up from the bear channel, yet still maintaining the longer term overall bearish incentive. And that's the end of the quote. So you can see from that, I'd have been happy for a move up to the green and mauve moving averages to relieve the bullish pressure and possibly resume the bearish incentive. Well, prices so far have not even managed to make it as far as the short medium moving average before turning lower. Now, that doesn't mean the bullish pressure is assuaged. No. You see, even today, we are seeing support at the January 2021 low. So I'd still keep target X2 and X3 in mind, but not at the cost of still looking at what might be the bigger bearish pressures out there.
Thank you for listening. This weekly broadcast gives the essential market patterns and consequences. Please be aware of the risk disclaimer posted both at the front and at the back of this broadcast. Copyright is Eddie Tofpik and ADM Investor Service International Limited. And here comes the final important bit.